Welcome to How to Evaluate an Investment Opportunity, Key Steps and Considerations. This is the third lesson in the essential lessons for becoming a sophisticated investor. We're going to start off with risk management. We're going to define what risk management is, and then we're going to talk about how to determine your risk tolerance. So, what is risk management? So, it's the process of identifying, assessing, and prioritizing risk, followed by coordinated efforts to minimize, monitor, and control the probability or impact of unfortunate events. So your risk level determines the minimum ROI that you'll accept for any investment or any risk. So the higher your risk level, the higher the minimum ROI needs to be in order to satisfy your risk appetite. So let's jump right into the types of risk. So the first is market risk. This is the risk of loss due to factors that affect the overall performance of the financial markets. These risks can be categorized into three categories. So the first is equity risk. This pertains to investments in shares or real estate and the possibility of market fluctuations. So in dealing with shares, there may be news that affects the share price going up or down. With real estate, the equity in a property is determined by the market and how much you can sell the property for. Interest rate risk is related to changes in the interest rates. Mainly affects the values of bonds and loans and other fixed income investments. And then there's currency risk, which arises from fluctuations in foreign exchange rates, which affect the value of investments in foreign currencies. The next is credit risk. This is the risk that a government entity, corporation, or a counterparty will default on a financial obligation. Credit risks are particularly relevant in the context of bonds, loans, and credit derivatives. So with the United States and its high debt, it has never defaulted on debt, but its credit rating has come down because our debt is such a large portion of our GDP. And so the credit risk associated with investing in US bonds went up. Liquidity risk. This is the risk that an investor won't be able to buy or sell an investment quickly without causing a significant movement in price. Liquidity can be particularly low in thinly traded markets or for complex products. So if you're investing in over-the-counter stocks that are thinly traded and you want to buy a lot, because of the low liquidity and your desire to buy a lot, the price will go up significantly because of the imbalance between supply and demand. The same can be said in real estate. If you have a property that you want to sell, but there aren't a lot of buyers, then the price that you'll be able to get for it will be a lot lower than if there were more buyers. Operational risks. This includes risks arising from execution failures, such as business errors, failures in internal processes, or the impact of external events on business operations. Um, so this can include something as simple as clerical errors, where we are investing in a company and the company issued a set of financial statements. And so we invested based on the information in that financial statement and come to find out there was a clerical error in that financial statement that overstated, for example, profits. And so therefore the value of the investment goes down because of that clerical error. Or it could be more severe, like fraud, where again, we're investing in a company based on a set of financial statements that says one thing, and then come to find out that the information in the financial statement is not only inaccurate, but it's made up. And so the Bernie Madoff case is a good example of fraud in financial statements. Legal and regulatory risks. So these are risks related to the legal environment in which investment activities occur. And so changes in regulations, legal actions, and being non-compliant with laws can have significant implications. So we're seeing a lot of changes in current regulations, which may make it more profitable for certain companies because of the relaxation of regulations and them not having to abide by certain regulations, which means they don't have to incur certain costs. And so the cost savings drop down to the bottom line. Or we can have the implication with non-compliance, in which you could be subject to severe fees if you are non-compliant, which can affect the bottom line also. Geopolitical risks, events in political or economic environments in other countries can affect global markets, commodity prices, disrupt global supply chains. So we are currently seeing that with the implementation of tariffs that the president is implementing and the retaliatory tariffs that other countries are implementing against the United States, and how that increases the cost of doing business. And so businesses can either pass on that cost, which gets to the next risk that we'll talk about, or they can absorb that cost and reduce their profits. And so inflationary risk, the risk that inflation will erode real return on investments. So this definitely affects fixed income investments like bonds. And we saw in the last couple of years the effect that inflation has on business and on profits, and on people's lives. And so if you're investing in income producing assets, the inflationary risk is something that you have to take into consideration when looking at what your net operating income is going to be. Reinvestment risk. This is the risk that cash flows from an investment will be reinvested at a lower rate than the original investment. This is a common risk associated with bonds and other fixed income products, where you take the interest payments and they need to be reinvested in order to generate more interest payments, but you're reinvesting at a lower rate than the original investment. So concentration risk is when an investor's portfolio is not diversified and is heavily weighted toward a particular asset or particular location, making it more susceptible to market changes. So if your concentration is all in real estate and all your real estate is concentrated in California, Northern California office, let's use that as an example. The last couple of years have been extremely tough for office space throughout the country, and particularly hard for office space in Northern California and in Silicon Valley. And so if you would have invested only or the majority of your portfolio in office space in Northern California, you were susceptible to concentration risk. Longevity risk is simply you outliving your investments. This is particularly relevant in retirement planning, but there are some strategies to mitigate this risk so that you never outlive your investments. So we're going to start now with looking at what are some risk management strategies. So the very first thing is you got to identify the risk. So how do you identify the risk? So you can do market analysis, conduct thorough research on market trends and economic indicators. You can look at historical data. Again, I give the example of investing in a company and looking at their their financial statements. You can get expert consultation. You can seek the advice from financial advisors and industry experts. You can do scenario analysis, what ifs, to evaluate different potential scenarios and their impacts on investments. Then you can also do a SWOT analysis, strengths, weaknesses, opportunities, and threats that are related to an investment. So once you identify the risk, the next option is how you're going to manage the risk. So diversification is an effective management technique where you spread your investments across various asset classes in order to reduce exposure to any single asset class. There's also the importance of asset allocation, where you adjust the mix of asset types based on risk tolerance and investment goals. So one popular asset allocation is a 60-40 split between 60% stocks and 40% bonds. And once, as you approach retirement age, then your percentage of stocks decreases, your percentage of bonds increases. And that allocation strategy was based on the idea that when stocks go up, bonds go down, and when stocks go down, bonds go up. And so they offset each other. But there have been times, including recent times, where we have seen stocks and bonds move in the same direction. Stop loss orders, where you set a predetermined price for selling the asset. And so you can do this very easily if you're trading in stocks, if you're trading options, if you're trading crypto, you can set stop loss orders so that if the price drops below a certain amount, it automatically triggers a sell order. Or you can not have it be so official. So for example, let's say you're investing in real estate and you are seeing the value of your property decrease. And so you can set a price mentally that if the value of my home gets below a certain amount, if the value of my real estate gets below a certain amount, I'm going to start the selling process. Hedging. So this is where you use financial instruments like options and futures to offset potential losses. So if you own a stock and you bought the stock at $100, you can buy what are called put options. And you might have a put option with a strike price at 90. So what that means is if the price of your stock falls and it goes down to 90, then your put option would kick in and then you would automatically sell your stock for $90, even if the stock price continues to fall down. So it's like a stop loss order, but it's a guarantee that someone will buy your stock if it gets down to that certain price. So that's an example of hedging. One important strategy is regular monitoring, right? Doesn't mean that you got to look at your investments daily, but you need to look at them on a regular basis, at least on a monthly basis. And then there are risk assessment tools that you can use. You can use software and other type of tools to analyze and monitor risk. Another strategy is shifting. risk. The number one method of that is insurance. So if you're a real estate investor, you're going to make sure that you have property insurance against fire and other hazards that might destroy your property. So you're going to shift that risk to the insurance company in exchange for paying them a premium. If you're a business, you're going to make sure you have general liability insurance from being sued um, for in the process of conducting your business. But the insurance is there to cover specific risks. You can also enter into contracts that transfer risk to other parties, such as service contracts and warranties. You can use the derivatives like the hedging that I just explained. But you could also use partnerships as a way to share risk. Now, when you share in the risk, you also share in the rewards also. And then you can outsource, you can delegate certain business functions or processes to third parties who assume the associated risk. So now we're going to talk about what are the financial impacts of risk. We're going to talk about assessing the financial impact of losing an investment and what would that impact be on you financially if you lost all of your investment. So here's some questions to consider. How are the risks associated with the investment that you're looking at? How are they being managed or shifted? How are you or the person managing the investment managing and shifting the risk? And then are you comfortable with the risk and how they're being managed? And a lot of that has to do with your risk tolerance. If you have a low risk tolerance, then you're going to want to make sure that the risks are definitely being well managed and or shifted to other people. If you have a higher risk tolerance because you're seeking a higher reward, the importance of how the risk being managed may not be as important to you because you're looking at the underlying benefits of the investment. So now we get into money management. Money management is just as important as risk management. And we're going to talk about some key aspects of money management and the importance of maximizing return and minimizing risk. So asset allocation. This is a process of dividing an investment portfolio among different asset categories: stocks, bonds, real estate, cash, fine art, jewelry, all types of asset classes. And how do you determine what your asset allocation is going to be? And so that's based on your financial goal, your risk tolerance, and your investment horizon. What's the time frame that you have for investing? And then there are factors that also influence your asset allocation, such as what's your financial situation and what are the market conditions. Diversification. We've talked a little bit about this. Spreading investments across various financial instruments to reduce exposure to any single asset or any single risk. And so the way diversification works is it helps achieve a more stable return by mitigating losses in one area with gains in another. I talked about the allocation strategy of a 60-40 allocation split between stocks and bonds, and based on the premise that as one goes up, the other goes down. That is not always true. And so when we look at diversification, you may want to diversify your assets beyond just stocks and bonds and get into other asset classes to help create that more stable return. Positioning sizing. So, or position sizing. This is important. It determines how much capital that you allocate to a particular investment, and it has to do with controlling risk. You don't want to put all your eggs in one basket. You don't want to put all of your investable money into a single investment. Um, this is where, again, allocation, asset allocation, and diversification come into play. Allocating investable funds. So here are some guidelines for allocating funds. You want to allocate them according to risk, and the lower the risk, the greater the allocation. If the risk is equal among different investment opportunities, then you want to consider allocating your funds equally. Now, this has to do with your risk tolerance. It also has to deal with your horizon, how long. And so I'll go back to the example of the 60-40 split, where you're actually going in that strategy, you're allocating more money to a higher risk asset class um, because you have a higher um, time horizon for investing. And so the allocating of investable funds is really based on your risk tolerance as well as your investment horizon. The longer the horizon, the higher your risk tolerance, the more that you should allocate to those higher risk asset classes. So let's talk about investment strategies. So I categorize investments into two categories. There are appreciating assets, which grow your money, and there are cash flow assets that generate a steady stream of income. So I tell people to look at money like children. And when your children are young, you want them to grow. So when while you are working and you have disposable income and you're allocating some of your disposable income to investing, you want to grow that money. And so, therefore, while you are working and you have disposable income, I recommend that you invest that money into appreciating assets to grow your money. Um, Now, once you reach your financial independence number, you've grown your money, you've implemented your asset accumulation plan, and you've reached your financial independence number. Now it's about changing strategies. And this is where you convert your appreciating assets into income producing assets. Your income producing assets should have a lower risk level. Um, and they should be about creating a steady stream of income and insulating yourself from market forces um, and the other risks that we've talked about. So let's talk about some position sizing rules. Um, these are common rules of thumb. A lot of it has to deal with how much investable money that you have. The greater the amount of money, the more that you can stick to this rule of thumb. Um, the smaller amount that you have, you're not going to be able to stick to this rule of thumb of allocate no more than 5% into any single um, position. Okay, so just a rule of thumb. So if you got $100,000, then that says that you shouldn't put more than $5,000 into any single position. Okay. If you have $500 or you got $1,000, let's say you got $1,000, that means that you don't put more than $50, and that's an unreasonable assumption. Um, And so when you have to allocate more of your investable money into a position, that's where you need to look at the risk factor in your risk tolerance. And you have to ask yourself, how would I be if I lost all of this? And that's ultimately the question when it comes down to risk. When you are working and you got disposable income, you should have a higher risk tolerance, because if you invest your money into an investment and it doesn't work out the way that it was planned and you lose all of your money, you still are working and you still are creating more disposable income that you can um, invest, versus if you have reached your financial independence number, or you've retired and you don't have that disposable income. And so now you're relying upon your investable money to create recurring um, monthly revenue. Um, and your tolerance for losing it all um, is that you would be devastated. That's where you need to invest in only cash flowing properties or cash flowing investments. Um, and so you got to ask yourself, what is my risk tolerance financially and emotionally? That's right. So you could be working right now, have a lot of disposable income, um, but emotionally you have low risk tolerance, right? You're a worrier, and you worry a lot about, if I lose this money, it may not set me back financially, but I'm just worried about losing it. If that's your emotional state, then you need to invest in less risky things. But if you have an emotional state where, hey, if I lose it, oh well, I'll just make some more money and I'll invest in something else, then you can take those higher chances and invest more into riskier investments. So, to compare one investment to another, we've created the investment opportunity scorecard. Um, and I'm going to go over it briefly. You can download it and you can play around with it. So, the key factors in the scorecard, the amount of your investment. And so, if you've got a certain dollar amount to invest and you've got several investment opportunities that you're looking at, you're going to put that same amount um, in each of the different investment opportunities. What are the minimum investment period in months? So some investment opportunities are going to lock up your investment for a certain time. It might be um, 3 months. It might be 6 months. It might be 18 months. It might be, um, several years. Um, and that then goes to what is the projected investment period. So you may have it where the minimum investment is 3 months and the projected investment period is 6 months. Or it may be where the minimum is 18 months and the projected investment period is 5 years. Okay. Or you might be in something that's extremely liquid, like a money market account, where there is no minimum investment period. You can move your money inside and out, and your projected investment period is how long do you expect to have your money in the money market account. The total amount of potential reward return. Um, this is where you calculate what is the total amount that you're going to make over the projected investment period. And then that's going to calculate your annualized ROI, so that you'll be able to compare annualized ROI from one investment to another investment, compare apples with apples. And then there's the liquidity. How easy is it to sell, to get out of your investment position? Are there positive tax implications? Are you going to be an active or passive involvement? And does this have a high, low, or medium probability of success? And then the ultimate thing is the financial impact of failure. If this fails, how much money are you going to lose? Are you going to lose all of your money? Or are you going to lose part of your money? Or if you're investing in, bonds or in money market, where there's really no way to lose your money, then the financial impact of failure would be zero. And so you're going to enter values of 0 to 10 for the score of each factor based on how you feel the answer to each factor affects how you like or dislike the investment opportunity. This is geared toward you. Each person is going to have a different risk tolerance. Each person is going to have different feelings about the investment opportunities and the risks associated. And so once you do that, then the scorecard will automatically add up all the scores and give you a total between 0 to 100. And so you can use this score to compare different investment opportunities, especially if one of the risk opportunities is a risk-free investment like a money market account or U.S. Treasury bonds. So here's an example of a completed scorecard. On the right, you have the money market account, which is the risk-free investment. And then we've used the example of a Detroit real estate flip and a Detroit real estate buy and hold. And again, this is just an example to show you how the scorecard looks when it's completed. But these are all subjective scores and subjective selections to the orange fields of low, medium, high, or very high. It's all subjective. And so use this scorecard as a tool to allow you to compare one investment opportunity to another investment opportunity and recommend that one of those investment opportunities be a risk-free investment opportunities such as a savings account, a money market account, or U.S. bonds. So let's recap key points. You want to determine the level of risk that you're comfortable with, and then you want to identify the risks associated with the investment. And we've gone over the many different types of risks that they are. And you want to determine how the risks are managed and how the risks are shifted, and use a tool like the scorecard to compare investment opportunities. And then the final tip for evaluating investment opportunities is practice sound risk management and money management strategies.